silver, based on this chart pattern, run to about $68, $69 an ounce. It could happen literally within 2 or 3 trading sessions based on this chart pattern. So we could see silver and metals have a big pop this week. After the first week and a half of December, we tend to see precious metals want to go higher. And usually gold and silver move up together, even for equities to have a final push. Gold is a little bit more conservative. This is a huge run up. It's at a big pause. It is pointing to about $5,200 per ounce. And right now, if we zoom in on the shorter term chart, we've got a very strong bull flag pattern, just very similar to silver. It's had a nice run up. It's had a pullback. And it's just showing that in the short term, while silver shows about a 17% move, gold shows roughly about a 6 or so % move. And
does silver need to pull back? The 20-day moving average, does it pull back to there? Does it go back to the old, what was resistance becomes support up, at around 55? If you're looking for a dip to buy, where would you look?
We're going to see money move into the more speculative side of things. Yeah, well, silver's got a beautiful chart. As you and I know, we're in a time where I think silver, precious metals across the board are set to continue to push higher and potentially go really ballistic and take off over the next couple of months. But when we look at the short-term chart of silver, we've had a lot of different stuff, different patterns on different time frames unfold. But we just had this great big pause. We had a big rally up to this level, which, depending on where you want to draw this level, either way, it's a beautiful big pause, a consolidation, meaning that this is just a little bit of a temporary pause before it goes higher. And now we've seen it break out. We've seen it run higher. And now it's forming another bull flag pattern right here. We've had an explosive move up over the past 2 weeks. It's been trading sideways. This looks like a high momentum move, meaning we could see silver, based on this chart pattern, run to about $68, $69 an ounce. It could happen literally within 2 or 3 trading sessions based on this chart pattern. So we could see silver and metals have a big pop this week. So it's pretty exciting when we look at the chart, and using technicals. If we use Fibonacci extension, it gives us a good idea of just this short-term rally and this pullback that we've seen.
This is the kind of setup where the chart quietly tells a bigger story than the headlines. Chris Vermeulen highlights a textbook bull flag continuation, and when a consolidation this clean forms after a 2-week surge, it often signals institutional accumulation rather than retail noise. A projected move to $68, $69 matches the Fibonacci extensions he cites, and that aligns with typical silver momentum phases noted in 2010 and 2020. If this breakout confirms, liquidity will rush in fast. Next, the target math gets even more aggressive.
It tells us where the next 2 upside targets are for silver. So $64 is the next upside target. Based on where price is right now, it's about a 10% move. And if we do have this 100% measured move, that's going to be around a 17, 18% move to the upside. So this could be a really nice explosive move in silver if it can get its momentum going over the next couple of trading sessions. And when we look at, I don't have it for silver, but silver and gold are pretty much the same. When we look at the seasonality chart, as you like to always pull up here, Craig, we're coming into that time of year, like pretty much right now, after the first week and a half of the year or of December, we tend to see precious metals want to go higher. And usually gold and silver move up together. And so we're coming into the sweet spot, not only for precious metals, but even for equities to have a final push higher. And so silver is really exciting because percentage-wise, it's got a very big move, primed and ready. And as we can see from this last portion of this move, in more or less, it was 5 trading sessions, it kind of made a very significant move percentage-wise. If we look at that move, it was about 24%.
The real story here is how the seasonal tailwind aligns with measurable upside targets. A rare moment when technicals and historical patterns point in the same direction. Chris Vermeulen notes a 10-18% extension, and that fits the December-January strength shown in 30-year seasonality data, where silver outperforms gold nearly 70% of the time. But the key is discipline. A 24% surge in just 5 sessions is the kind of move that tempts investors into chasing. Momentum is real, but exhaustion can be just as quick. And the next section tackles whether a pullback is even necessary.
So I think there's some excitement just around the corner to end the year on a very strong precious metal note.
If I asked selfishly, but probably for a lot of other people out there. Does silver need to pull back to that? What is that red line? That purple line, I guess, is what it is. Is that like the 20-day moving average? Does it pull back to there? Does it go back to the old, what was resistance become support up, at around 55? If you're looking for a dip to buy, where would you look?
Yeah, I mean, if we use Fibonacci retracement, we could say, well, based on that move, the sweet spot will be between about 52.50 up to about 55.40. So right around this breakout zone that you just mentioned, right where this pink reddish line is. So that would be a healthy pullback range. The chart pattern right now is actually primed and ready to pop and really take off. This is a very high momentum move. So if it does pull back, I think it's an opportunity. If you're not long it right now, I think I do think it's gonna move up here. So either way, all the time frames for silver and precious metals are bullish on all time frames to the upsides.
Here's the contradiction. No one on financial TV mentions a market can be overextended, yet still offer a textbook retracement zone that institutions love. Chris Vermeulen points out the $52.50 to $55.40 range, exactly where prior resistance flips into support, a pattern that has repeated in silver's 2016, 2020, and 2023 rallies. When all time frames line up bullish, retail investors usually panic at dips, while funds treat them as scheduled entries. The question is whether momentum even allows that dip. Next, gold enters the conversation and the tone shifts.
So at this point, it's in a very strong rally mode. You need to own it.
You mentioned the seasonality, but also we've got the December FOMC meeting that is pending, and all sorts of potentially bullish news coming down the road. So let's keep an eye on that one. It'll be fun to see where we are by the time we record another one of these videos in early January. Let's shift to gold, though, Chris. Gold ran higher with silver through September into October. It has since put, I'm reluctant to call it a lower high just because what followed that was a higher low.
Yeah.
So, but it's not broken out past its October highs like silver has. So what are you watching here? That penny?
Yeah, I think gold's, I think right now we're seeing the precious metal space has really come to life. Everybody's kind of on high alert for it. So naturally, we're going to see money move into the more speculative side of things, which is why I think we've seen silver move first. People have moved into it quicker. It's a smaller market. They want to make higher returns. So silver's already popped and broken out. Gold is a little bit more conservative. It still has a very strong chart pattern.
Gold's hesitation here exposes something investors often forget. Leadership inside precious metals rotates just like equities. Silver's early breakout reflects its smaller market cap and higher beta, while gold's higher low suggests accumulation without urgency. Chris Vermeulen correctly flags the December FOMC as a volatility trigger. Historically, gold gains in 11 of the last 14 post-FOMC periods, when the Fed signals policy stability. The market's high alert mood means rotations can flip quickly once gold confirms. Next, the long-term target for gold may surprise people who only watch headlines.
This is a huge run-up. It's at a big pause. It is pointing to about $5,200 per ounce when all this unfolds. And right now, if we zoom in on the shorter-term chart, we've got a very strong bull flag pattern, just very similar to silver. It's had a nice run-up. It's had a pullback. And it's just showing that in the short term, while silver shows about a 17% move, gold shows roughly about a 6 or so percent move. And that's typical. Silver percentage wise moves a lot more when it has a run. So I think gold is a little bit slower moving. I find it's more accurate. I find I can win more trades with gold. And see, there's always a trade-off, right? Either you can knock some out of the park, have some huge gains, but you might not win many trades because they're a little more unpredictable, like silver, or you make lower returns, but you win more trades and it's less volatile. So there's two different characteristics between these opportunities. And gold's doing what it does. It's being a little more conservative. It's lagging a little bit at this point. I think money's looking for higher returns than gold, which is silver. And I think miners and platinum and palladium. I think there's money's starting to figure out, trying to spread out, I think, in the precious metal space right now.
A $5,200 target may sound sensational, but the structure Chris Vermeulen describes, a long consolidation followed by a measured move breakout, matches gold's multi-year rhythm seen in 2005 to 2011 and again in 2018-2020. The smaller 6% short-term upside versus silver's 17% highlights why institutions treat gold as the accuracy trade. Steadier, slower, but statistically more reliable. The rotation he mentions into miners and platinum is also consistent with prior cycles, where capital spreads once gold stabilizes. Next comes the part where the trend truly gets tested.
We've got about 3 weeks to go in the year. I don't know, with the holidays, maybe I get 14, 15 trading days. So even let's just assume we go sideways for the rest of the year and take a look at the annual charts, where you can really see the longer term trends. We go from the hourly charts, the daily charts, the weekly charts, the monthly charts, the quarterly charts. But how about an annual chart, my friend? What do you got?
Yeah, I don't know if you and I have looked at these yet.
Goodness.
But obviously, we've got a pretty explosive bar. We've never seen a bar. I mean, it'd be interesting to go back here. If we look at these green bars, percentage-wise, there was a 149% bar. Let's see what some of these other bars are. That was a 30%. So this bar that we have right now, I mean, if you think about it, it still has a lot of potential to be back similar to the late 70s, where we've seen bigger spikes than what we have right now. But when you look at it from this chart standpoint, it's a pretty big spike. Let's take a look at the log chart. If we kind of look at the log, it gives us a bit more of a balanced view.
The annual chart often exposes trends hidden on daily or weekly frames. Chris Vermeulen points out a 149% spike historically, dwarfing typical annual gains like the 30% bars from prior cycles. Even the current bar, though not the largest ever, signals a strong upward impulse that few retail traders notice. Log charts confirm momentum without exaggeration, balancing perspective for long-term investors. The real takeaway is that annual frames provide context for potential blow-off moves. Next, we evaluate how this momentum translates across all time frames.
But I mean, we're just in this big rally mode in precious metals. There's no doubt the trend is up. I don't think anybody's really trying to pick a top in gold, because that's just a bad opportunity or a bad play. You really just have to ride this trend up until it's proven wrong and until it reverses on multiple time frames, from potentially the 30-minute to the daily to the weekly or the monthly chart. And then you'll be like, okay, maybe the trend is done. So when we look at it from an annual standpoint, though, the gold has had a beautiful move. If we were to look at it from a Fibonacci standpoint, based on this rally up here, this pullback through here, we have blown past the 100% measured move based on this past yearly pattern. If we go back even further, this is a much bigger one. Let's just clear the chart up. We can go based on this low back over here from 2000. We can go to the peak in 2011, the low back here. You can see here, we're still above all of the targets. And this is why I've been talking about it for a while, is we're in this kind of, I hate to say bubble phase or blow off phase, but we've hit the measured move targets for gold. And so now we're in no man's land. You just have to ride the trend. We're in the perfect environment for precious metals to go higher.
Gold isn't topping. It's traversing a multi-decade trajectory. Chris Vermeulen emphasizes that even after surpassing 100% measured moves from historical patterns, the trend remains intact, illustrating why selling into momentum without confirmation is risky. Looking back from 2000 to 2011, targets have been exceeded, yet the upward trend continues, supported by macro tailwinds. Investors should focus on trend validation across multiple timeframes rather than guessing tops. Next, we explore how short-term charts refine the next upside targets.
And now you kind of drop down to these shorter-term charts, which, if we go back to the daily chart, this is where we can get an idea of where the next critical targets are, because the yearly chart, we've already blown past all that. So we could grab the low from this last bull flag pattern, the high that we've had, and this recent low. And this will give us an idea of where this next run is going to go, which is about 51.75 for gold. If we to see what that is, it's about a 22% move. So there's a lot of potential still for gold. To the upside over the next couple of months. We could potentially see money rotate into this space. I think one of the big things that'll be interesting to see play out is if the stock market eventually stalls out and rolls over. And if it does, is the money that's coming out of equities, is that going to pile into precious metals and send them sharply higher?
Short-term charts can clarify the real opportunity that annual charts mask. Chris Vermeulen identifies a 22% potential move to 51.75, showing that measured momentum still favors gold despite macro noise. Historical rotations after equity stalls like 2020's Q4 suggest inflows into precious metals accelerate when stocks falter. Investors watching this pattern can anticipate where capital is likely to rotate next, giving context beyond headline volatility. Next, the relationship between equities and metals comes sharply into focus.
I think it will. It's just a matter of waiting for the stock market to actually roll over and start to sell off, and for that new money to be raised to get put to work somewhere. And typically money, when there's cash on hand, people look to whatever's performing best to move into. And I think precious metals are definitely that space.
That's remarkable. You came up that 5,200 number. As we've discussed, that weekly chart ever since price broke out in March of 2024 just continues this pattern of 20% rallies and then a 4 month consolidation, then another 20% rally. I mean, you can see it right there.
Yeah, I mean, it's never ending. It's just a constant phase of 20, percent rallies over and over again.
Isn't that remarkable?
Yeah. So, I mean, and the 5,200 comes out at anher 20% gain, right? That's how the market is. It stair steps its way up and then eventually takes the elevator down. But there's no doubt like this, we're in a strong bullish chart power. And the question is, does this weekly chart go on for another 10 or 12 bars, which could be 2 or 3 months, or does it just pop and break out and pick up speed and hit that next upward target? We don't know, but the trend is up.
Investors rarely hear that metals can compound in repeated, mechanical 20% cycles. Yet Chris Vermeulen lays out a clear pattern from March 2024 onward. Each consolidation followed by another rally is a stair-step market structure that rewards patience over timing. The $5,200 projection is not arbitrary. It reflects a disciplined, measured move strategy embedded in historical weekly charts. Ignoring these patterns risks chasing momentum blindly. Next, patience becomes the core strategy, not timing.
You just have to let it mature. It could take 3 weeks. It could take 3 months. It's not about so much timing the market. It's about knowing what trajectory and trend it's on and then just taking advantage of it. Let the chart do the work. Don't try to rush anything, or else you'll get into a bunch of premature trades or get out of trades too early. Because the market, if it doesn't shake you out, it will wait you out. And that's what it did with this last one over here. I mean, it took forever for this bull flag pattern to play out. People started to give up on it. And then boom, it took off. And people are like, people are just too impatient.
Yep. Well, people might be listening to this going, well, it can't be that easy. And it's not. However, when we stalled out at 3,100 or whatever it was back in, January and into February, well, that set the next target. And then, by April, we're at 3,500. Then we stalled out again. The next target was projected to be about 4,200 and away we went. You just, like you said, you had to be patient.
I know. Well, you and I have been doing these reports for the last couple of years, and we just draw these targets each time.
Patience is the overlooked currency in metals trading. Chris Vermeulen demonstrates that waiting for bull flag patterns to fully develop prevents premature entries and unnecessary losses. Historical sequences, like stalling at $3,100 before climbing to $4,200, underscore that measured progression, not panic, governs sustainable gains. For investors, this means following trajectories instead of chasing short-term spikes, preserving both capital and confidence. Next, we'll see why this method beats emotional trading over news-driven moves.
And we just keep hitting them time after time after time. Like it's not rocket science, but it is hard to do it because you get hooked into news and emotions and you worry about giving back too much gain if it starts to pull back a bit, and then you worry about missing out on a move. It's the emotions and the news really take over. If you could pull that away from the market, get that out of your head and just follow price patterns, which is what I do, which is what I try to help other people do, it really makes things a lot easier. But the problem is, no matter how much I try and keep people on the straight and narrow, like just follow the price charts. This is what it's saying. This is what it's pointing to. they always have all this, they're inundated with news and other people's, opinions and extreme chart analysis that will scare the hell out of people and make them make decisions. So it's really tough. It's tough to put the blinders on and just be like, just let the next 20% move play out. And if it puts in a topping pattern and starts to break down, we'll be able to identify it and we get out. And you're never going to get out at the top. You're always going to have to give back a good chunk of some profits.
Emotional noise is the hidden enemy of profitable investing. Chris emphasizes that even small pullbacks can tempt investors to exit prematurely. Yet historical patterns show that letting measured 20% moves run is more reliable. News cycles and extreme opinions often distort risk perception, which is why blind adherence to chart patterns provides clarity. Recognizing that no one exits at the absolute top reinforces disciplined patience. Next, we explore how giving back small gains is a normal part of multi-year trends.
Before you know a new downtrend, like the uptrend has ended and then a new downtrend has started. So if you can always realize that you're probably going to give back potentially 5, 10, 20% of a massive, big multi-year trend like this, that's just part of the game, but you have to let it prove that the trend is over before you get out.
Right. Chris, let's just do one more. And if you wouldn't mind, let's look at some kind of proxy for the mining sector, whether it's a GDX or one of the spot ETFs, whichever one you want to follow, you can pick.
All right.
I find it intriguing. And again, it's about patience and waiting to see what happens next. We had this run up, blast to all new all-time highs in the GDX back in October. It then pulled back all the way back down to those old all-time highs around 68, but it's yet to take off. We're now, like I said, there's only 3 weeks left in the quarter. Gold's average price is 4,100. Silver's average price is north of 50. Dramatic increases over the third quarter, but yet the shares are still kind of, it's like mining share investors don't know what to do. So what do you make of this technically on that chart?
I mean, it's doing similar to gold.
Multi-year trends demand tolerance for partial reversals. Chris highlights that 5 to 20% givebacks are normal and part of trend evolution, not a signal to exit prematurely. Using proxies like GDX or SPDR ETFs reveals that mining shares often lag metals themselves, with pullbacks to old highs before resuming upward, despite gold averaging $4,100 and silver over $50. Investor hesitation creates volatility opportunities. For disciplined investors, patience and observing trend confirmation remain essential. Next, we examine how minor patterns mirror metals but with amplified volatility.
I mean, we can look at it here, like you get a rally up and then it pauses for a while, and then you get a rally up and then it pauses for a while. So this is, I think you just have to look at this. Miners are a little more volatile. They'll shake you up. They'll make some higher highs, some lower lows, and you won't know what to do. And that's exactly kind of what they've been doing. But there's a pause here. And really all we are right now is the same with gold. Gold, they're just in a pausing phase, right? I'm expecting we're going to see this eventually break to the upside. If we zoom into the daily chart, we get a much cleaner look of where we are. It's very similar to the price of gold here. Yeah. We've got this push up, we got a nice bull flag, and it's pointing to higher pricing here at any point. There's a couple of different bull flag patterns through here. There was this nice one here and it pulled back.
Yep.
And using simple Fibonacci, I mean, I always use this tool, but to me it's the most accurate tool there is to identify invisible resistance levels and targets. That's what I love about it, is because most people don't use it, and when things are hitting all-time highs or moving higher, they don't know where to put a target really.
Mining stocks amplify metals volatility, but follow similar technical patterns. Chris notes bull flags and Fibonacci levels reveal hidden resistance and upside targets often overlooked by casual investors. Daily charts show rallies interrupted by pauses, mimicking gold's movement, which provides a clearer roadmap for entries and exits. Understanding these subtle pauses helps manage risk in a sector notorious for swings. Next, we analyze how these technical setups translate into measurable upside for miners.
But Fibonacci gives us these perfect targets. So based on this previous run and this pullback, and we carry it over, you can see we came right up to the 100% measured move. And so now we're pulling back. So now we have another one unfolding right here. And this will tell us where the next upside target here for miners are, which is around the 90 level. So once they find some traction, I think we could see about a 13% move. And what's interesting here is silver has the best opportunity, better than miners. So silver is kind of the shining star at this point. It's outperforming. But there's no doubt the chart pattern on gold miners, this kind of rounding formation, you could argue now this is kind of a little cup and a handle formation with built-in bull flags. This is, if we were to do a cup and handle formation, it's typically the depth of the cup is one other way to measure where it could go when it breaks out. So if I was to just throw that on here, let's just pull the chart down. It breaks over the $100 mark, right? Yeah. So it'll be very interesting to see where this unfolds. The first target I gave you, the $68, is based on the daily chart or that was for silver. Sorry, this is for gold miners. But gold miners have got some pretty good potential to the upside, about 31% if this pattern was to unfold going forward.
Technical analysis reveals miners' upside is structured yet overlooked. Chris identifies a potential 13% move to the $90 level, with a cup and handle pattern hinting at 30 to 31% gains if breakout conditions hold. Silver remains outperforming, highlighting sector rotation and investor preference for high momentum metals. These patterns underscore why many retail investors miss actionable targets. They focus on noise rather than measured setups.